Hey, hello investors and future investors. Welcome to the channel. For today's video, I'm going to be showing you a simple option strategy that anyone could use in order to grow their small account portfolio. I'm going to go ahead and show you how this option strategy is able to go ahead and grow your account portfolio safely and consistently over time. Now, if you guys are new to options trading, or you guys are trying to use options trading in order to get some additional income, then you so happen to stumble onto the right video. Welcome to Investment Gains. Let's jump right into it. Welcome back, investors and future investors. My name is Tim, and on this channel, I show you how I use my portfolio in order to make consistent income. For today's video, I have one of the most exciting option strategies there is out there. This is going to be a four-leg option strategy, and it's very fun to do. In addition to this option strategy being extremely fun, this option strategy offers what's known as a high reward, low risk trade. I'm going to be giving you a step-by-step walkthrough in order for you to be able to follow along with me. Now, you guys know how we do it. Let's go ahead and get down and dirty with options. Our stock today, or our ETF rather, is going to be the Spider ETF, and that ticker is going to be SPY. So let's go ahead down to Trade SPY options in order for us to go ahead and get the option chain open. Now, this area down here is known as the option chain for all of those of you that are new to options. Now, what the option chain does is that it gives us enough information in order for us to go ahead and make a very informed decision before we enter into any options contract. Now, before I go ahead and demonstrate this super exciting option strategy, I always have two requirements for my viewers and also my subscribers. Requirement number one, always make sure to do your own due diligence before investing. What might work for my portfolio, quite frankly, may not work for yours. Requirement number two, always make sure to have an exit strategy before entering any options trade. That way, if the trade were to go against you, then you would be aware of how to get out of the trade. That being said, let's go ahead and get down and dirty with options. Now, for this option strategy, my personal preference is to start below the current share price. So let's go ahead and start that. Now, going below the share price, we're going to go ahead, we're going to go to sell, we're going to go to put. Now, I did mention this is a four-leg option strategy. So if you guys hear the excitement in my voice, it's because I absolutely love doing this option strategy. Now, what we're going to be doing, we're going to be doing weeklies. Weeklies mean we're going to be doing these option strategies with only 1 week to expiration. So the strike date we're going to be going with is going to be July 3rd, and that's going to give us 7 days to expiration. Let's go ahead, let's select that. Now that we have sell, now we have put, and we have selected our weekly expiration, now we're going to go ahead and choose our strike price. In order to maximize the efficiency of this option strategy, it is highly advisable that you choose your strike price below the current share price. The current share price right here is 612, so it's better to choose a strike price below that. Now, the criteria for choosing the strike price is going to be the chance of profitability. Now, the chance of profitability I'll be looking for is going to be around a 75% chance of profitability or higher. So let's go ahead and go down to see if we spot that. Now, here you go. The chance of profitability right here is 75%. That simply means that there's a 75% chance that this trade is going to go in your favor. Now, the strike price that corresponds with this 75% chance is going to be the 607 strike price. We're going to go ahead and we're going to select that. This is the first leg of this four-leg option strategy. Now, the criteria for choosing the first leg is going to be your chance of profitability. So let's go ahead and implement the second leg of this option strategy. Now, for the second leg, we're going to change up our top criteria, and we're going to go now to buy, and we're going to go to put, and we're going to still maintain the exact same strike date. Remember, it's important to keep the strike date. Once this strike date changes, you're going to be implementing a completely different options trade. So now we're going to go ahead and choose our next leg, which is going to be the 606 strike price. Now, the 606 strike price is going to be right below the 607. I'll explain to you why I went ahead with the 606 in just a second. Now, we're going to go ahead, we're going to select the 606. And there you have it. This first half of this Iron Condor is what's known as the put credit spread. The put credit spread in itself is an income generating option strategy. Now, the reason why I chose this 606 right here is because I wanted to minimize my option spread. Now, I will try to keep this video as beginner friendly as possible. So the option spread simply means the difference between your strike prices. So the difference between my strike prices here is going to be $1. 607 minus 606, $1. What that's going to help you determine is going to help you determine the amount of collateral you're going to need to leave for this trade. So let me just go ahead and continue right now. I will show it to you. We're going to hit review. So right now, if you had to do this half of this Iron Condor, you're going to have to leave collateral of $100. So the reason you have to leave $100 is because your spread is $1. You multiply that by 100 shares, and that's going to give you $100. Just for analysis, I'm going to go ahead and choose a different strike price to show you how your collateral changes. So now we're going to go two strike prices below the first one. So we're going to go with the 605 right now. Let's go ahead and select that. And as you can see here, your collateral has changed. So my reason for going with the 606 is to minimize the amount of collateral that I'm going to use for this trade. So let's go ahead and continue with the Iron Condor. So this represents the first half of the Iron Condor. Now remember, my first criteria for choosing my first leg was the chance of profitability. Now, let's go ahead and work on the top half of the Iron Condor. And for that, we're going to go ahead to sell. We're going to go to call, and then we're going to maintain the exact same strike date. Now, in order for this half of the Iron Condor to be the most efficient, it is highly advisable this time to choose your strike price above the current share price. Now, this time, my first criteria to choose my first strike price is going to be an 80% chance of profit or higher. So let's go ahead and see if we could see that. So here you go, an 80% chance of profit. Now, with the 80% chance of profit, the corresponding strike price is going to be 619. Let's go ahead and I'm going to select that. Now, the reason why I chose an 80% chance of profitability is twofold. Number one reason is that I feel confident choosing an 80% chance of profitability or higher. That's just based on my own risk tolerance and my portfolio goals. The second reason why I choose an 80% chance of profit is because the stock market usually goes up a lot more than it goes down. So on the downside, you guys saw that I chose a 75% chance of profitability. But when it comes to the top side, I would always increase my chance of profitability in order to make it harder for me to get a sign. Now, assignment just means that the trade is going to go against you. So here you have it. This right here is going to be the third leg of this four-leg option strategy. Now we're going to go ahead and we're going to choose the last leg to make this trade come full circle. Like I said, this is a very exciting option strategy. Now for that, leg 4, we're going to go ahead to buy. We're going to go to call while maintaining the exact same strike date. Notice throughout all 4 legs of this option strategy, we did not change the strike date. Now we're going to be doing quite similar with the first half of this option strategy, and we're going to be looking for a dollar wide spread. So we're going to choose the next strike price up, which is going to be 620. The difference between the 620 and the 619 is going to be $1. So once again, the collateral should be $100, but I will show you that as we go along. So now let's go ahead and we're going to click into that. And there you have it, the Iron Condor. Now, the Iron Condor is a 4-leg option strategy, and it's an income generating option strategy. The reason why the Iron Condor is such a nice option strategy, I mean, in addition to it being a 4-leg option strategy and being so exciting, it's an income generating option strategy, meaning that as soon as you do the trade, you get money right away. In this case, the amount of money you're going to get right away is going to be $24.83. Let's round it up to $25. Now, the amount of money you're going to be risking is going to be $100. So you're actually risking $100 in order for you to make $25. So that makes this trade perfect for people trading for a very small account. The downside of this trade is that it's not particularly friendly for beginner option traders because it is a 4-leg option strategy. A lot goes into it. But if you're able to go through all the different stages on all 4 legs, you will come out on top. Now, the other reason why I like this Iron Condor is the risk to return. The actual amount of money that you're going to be risking is going to be the money you receive, which is $25. You're going to subtract that from the collateral you leave in, which is $100, and that should give you $75. So in all actuality, you're risking $75 in order to make $25. In my opinion, that's a very good trade. The reason that's a very good trade is extremely hard for your Iron Condor legs to get broken. Let me show you what I mean by that. So in order for this trade to go against you, by expiration date of July 3rd, we're going to need this share price here to go above the 619 price right here. That's on the top side of this Iron Condor. Now, the other way you could lose this trade is that if the share price were to go down, it's going to have to go down past your 606 put on the downside. So the current share price right now at 612 needs to go below 606, or it needs to go above 619. Now, let me give you an option tip right now. The chances of this going to 606 is a lot higher than it going to 619. And the reason for that is that the Spider ETF, as of making this video, is making all-time highs. So stocks do not continuously keep going up. It goes up and it's going to have some kind of retraction before going up again. So there you have. That's just an excellent options tip for you right there. So there you have it, the Iron Condor. Once again, the Iron Condor is an excellent option strategy if you want to grow your small account portfolio consistently and safely over time. By doing weekly Iron Condors, you're now able to make at least around $25 every single week safely. If the trade does go against you, the amount you stand to lose is only going to be $75. So this option strategy is not going to allow you to blow up your account unless you go ahead and you increase your amount of contracts. Remember, when trading options, never use more than 5% of your portfolio for any trade. And that's pretty much if you're trading with a small account portfolio, anything less than $25,000. If you're trading with anything above $25,000, then the rule of thumb is not to go into any trade that risks more than 2% of your portfolio. The more money you have is the more money you need to conserve. So investors and future investors, in order to make the Iron Condor as simple as possibly can for you, break it up into two categories. Break it up into a put credit spread and also a call credit spread. And if you guys need to see how those two spreads work, just check out the video I did right before this one. So to come full circle with the Iron Condor, you're going to be implementing a put credit spread to the bottom side. You're also going to be implementing a call credit spread to the top side. Remember, your collateral is going to be based on whatever the option spread you choose. So be careful with that. Now, if you guys have any questions about the Iron Condor or any of these spreads inside here or your risk to reward ratio, let me know in the comments below. Now, this is going to be the perfect time for you guys to go ahead and like the video. Remember to subscribe to the channel, and most importantly, go ahead and hit the notification bell to get an alert when I post more videos of this nature. Now, here's a real treat for me and everyone that you know. If there's anyone you know out there struggling to grow a small account portfolio, then the right thing to do is to go ahead and share this video with them. Remember, we are trying to help as many as we can get away from that 9-to-5 job by making income with options trading. Now, until next video, keep pushing your investments.